Hello investors, and welcome back to the channel. Today we're diving deep into a sector that powers our world and potentially your portfolio, the energy sector. We'll be analyzing the current landscape, exploring how geopolitical currents, particularly involving US-Japan trade dynamics, are creating waves, and most importantly, identifying top US energy stocks that offer compelling prospects for both dividends and growth. Right now in 2025, whether you're seeking steady income streams or aiming for capital appreciation, the energy sector presents unique opportunities, but also carries inherent risks that we need to understand. Stick around as we unpack it all. First, let's set the stage by understanding the modern energy landscape, especially the position of the United States within it. The US has truly asserted its dominance in energy production over the last decade. As of recent data heading into 2025, US oil production is exceeding a staggering 30 million barrels per day. This represents more than 20% of the entire global oil output. Similarly, in the natural gas arena, US output has surpassed 100 billion cubic feet per day, accounting for nearly 20% of the world's supply. This immense production capacity not only fuels the domestic economy, but also positions the US as a critical global energy supplier, particularly through rapidly expanding liquefied natural gas, or LNG, exports. Since the ban on crude oil exports was lifted in 2015, US crude exports have surged, growing at a compound annual growth rate of around 27%, reflecting robust global demand for American energy. Looking at the demand side, forecasts suggest global energy demand is set to achieve new records in 2025. This marks the 39th rise in the past 41 years, primarily fueled by economic expansion in emerging markets. The International Energy Agency, the IEA, predicts oil demand will climb above 103 million barrels per day this year. OPEC forecasts are slightly more bullish, anticipating demand growth around 1.4 million barrels per day, while the EA projects growth closer to 1 million barrels per day. Both agree, however, that non-OECD countries, particularly in Asia with China as a primary driver, will fuel this expansion. Some analysts, like those at Goldman Sachs, foresee oil demand continuing to grow for another decade, driven by rising incomes and transportation needs in emerging markets, particularly for air travel and plastics manufacturing, sectors where decarbonization presents significant challenges. However, the rise of electric vehicles is starting to create a noticeable drag on oil demand growth. This drag is estimated at around 0.4 million barrels per day currently. Assuming EV sales continue their strong upward trajectory, this highlights the ongoing energy transition. While fossil fuels remain dominant and essential, the push towards cleaner energy sources like wind and solar is undeniable and accelerating. Companies like NextEra Energy are major players here, and even traditional giants like ExxonMobil and Chevron are making significant investments in areas like carbon capture, biofuels, and hydrogen to adapt to this changing landscape. A fascinating new factor influencing energy demand, specifically electricity, is the rise of artificial intelligence. US electricity demand has been relatively flat for over a decade, around 4,000 terawatt-hours annually, as efficiency gains offset population growth. However, the massive power requirements of AI data centers are poised to disrupt this trend, potentially ushering in what some call the age of electricity. This could significantly boost demand not only for renewables, but also for reliable baseload power sources like natural gas, benefiting energy infrastructure. So, we have a picture of strong US production, persistent global fossil fuel demand alongside a growing renewables sector, and emerging demand drivers like AI. This complex interplay sets the scene for investment opportunities and risks we'll explore further. Now, let's shift focus to the external forces shaping the energy market: geopolitics, trade, and tariffs. Energy markets are notoriously sensitive to global events, and 2025 is proving no exception. Analysts expect oil prices, specifically Brent crude, to average somewhere in the $70 to $85 per barrel range this year. This relative stability hinges on factors like strong non-OPEC supply growth, primarily from the Americas, the US, Canada, Brazil, and Guyana, which is expected to increase by around 1.7 million barrels per day in 2025. It also depends on the continued production discipline of the OPEC Plus group and the assumption of no major supply disruptions. However, geopolitical flashpoints remain a significant risk, capable of pushing prices well outside that forecasted range. For instance, heightened tensions in the Middle East or stricter enforcement of sanctions, particularly on Iranian oil exports, could significantly tighten the market. Goldman Sachs modeled that a drop of 1 million barrels per day in Iranian supply could push Brent towards the mid-$80, and a more severe disruption could temporarily spike prices near $90 per barrel. The ongoing conflict in Ukraine also adds layers of uncertainty. Adding another layer of complexity is the evolving landscape of U.S. trade policy under the current administration. We've seen the imposition of tariffs, such as the 25% tariffs on imported steel and aluminum earlier this year. While aimed at bolstering domestic producers, these tariffs drive up costs for industries reliant on these materials, including the energy sector, which needs steel for pipelines, drilling equipment, and infrastructure like wind turbines and LNG terminals. The cost of essential components like power transformers, already facing long wait times and double prices since 2020, could rise further if tariffs hit imported transformers or the specialized steel needed to make them. Tariffs targeting China specifically also have implications for the energy transition. For example, tariffs on lithium-ion batteries, of which the US imported 70% from China in 2024, could impact the burgeoning energy storage market, as there's limited alternative production capacity readily available, especially for LFP batteries used by utilities. While USA battery production is growing, the reliance on Chinese components and materials remains. Solar panel supply chains have also been subject to ongoing tariff adjustments, pushing manufacturers to shift production, but potentially raising overall costs for solar deployment. Furthermore, retaliatory tariffs from trading partners can impact U.S. energy exports. China, for instance, has imposed retaliatory tariffs that have blocked some U.S. oil and gas products, including about 5% of U.S. LNG exports destined for China in the past. While U.S. producers can often find alternative buyers for fungible commodities like crude oil and LNG, these trade frictions add uncertainty and can disrupt established supply chains and investment plans. This brings us to the specific situation involving the US and Japan. Recently, the US administration proposed a flat 10% import tariff on all goods, plus an additional reciprocal tariff, pegged to bilateral trade imbalances. For Japan, this reciprocal levy was calculated at 24%, potentially leading to a cumulative effective tariff of 34% on Japanese goods entering the US. While the implementation of the reciprocal part has reportedly been delayed, the underlying trade tensions remain. Japan ran a significant trade surplus with the US in 2024, around 8.64 trillion yen, or roughly $58.6 billion US dollars. Addressing this imbalance is a key concern for the US administration, creating a negotiation dynamic where energy plays a crucial role. Japan, being resource poor, is a major energy importer. In 2024, its LNG purchases from the US increased by 15% year-over-year, reaching 6.34 million tons, which accounted for nearly 10% of its total LNG imports. Japanese officials, including Prime Minister Ishiba, have signaled that increasing imports of US energy, specifically LNGs and potentially ethanol, could be part of a package offered to the US to mitigate the impact of tariffs and reduce the trade surplus. The proposed Alaska LNG project, a massive 20 million ton per year facility, has been mentioned in this context. Committing to offtake agreements from this project could be seen as a significant gesture by Japan towards the US. However, the economic realities of Alaska LNGs are challenging. The project has struggled for nearly 2 decades due to its remote location, high construction costs, including permafrost-resistant pipelines, and has yet to secure any firm long-term purchase agreements needed for financing. Furthermore, the landed cost of US LNG in Japan is already relatively high compared to alternatives due to long shipping distances. Factors like rising US liquefaction fees, increased input costs potentially exacerbated by steel tariffs could further erode its competitiveness. It's also important to note that Japan's overall LNG demand has been declining since its peak in 2014, driven by energy efficiency improvements, nuclear restarts, and a significant build-out of renewable energy capacity. Japan's draft strategic energy plan sees the role of thermal power, including LNGs, falling sharply in the coming decades. This has led to Japanese companies becoming increasingly active in reselling surplus LNG cargoes on the international market. The flexibility of US LNG contracts, which typically lack restrictive destination clauses, actually suits this emerging strategy quite well. So, while political statements emphasize increased US LNG exports to Japan, the actual flows will ultimately be shaped by economics and Japan's evolving energy needs, rather than solely by political maneuvering around tariffs. Some analysts even propose a more radical strategic realignment, suggesting Japan pivot away from its massive planned investments in green technologies, many sourced from China, and instead co-invest with the US in expanding fossil fuel production and infrastructure, both domestically and across the Indo-Pacific. This aligns with US strategic goals of countering China and promoting energy security, potentially providing a stronger basis for favorable trade terms. However, this would require Japan to significantly deviate from its current net zero commitments and face domestic political hurdles. In summary, the energy sector is operating within a complex web of geopolitical tensions and shifting trade policies. Tariffs can increase costs and create uncertainty, while trade negotiations, like those between the US and Japan, can influence energy flows, though underlying economics remain paramount. Investors need to monitor these developments closely. Given this backdrop of strong fundamentals, geopolitical crosscurrents, and policy shifts, why should investors consider energy stocks right now? Let's explore the compelling case for dividends and growth in 2025. One of the primary attractions of the energy sector, particularly established players and infrastructure companies, many large-cap energy companies boast long histories of consistent and often growing dividend payments. Think dividend aristocrats, like ExxonMobil and Chevron, who have increased their payouts for decades, rewarding long-term shareholders. Energy infrastructure companies, such as pipeline operators and storage facilities, are also known for high yields. In fact, forecasts for the energy infrastructure sector in 2025 suggest dividend growth accelerating to 5 to 7%, up from 3 to 5% estimates last year, reflecting improving fundamentals. Yields in this subsector often significantly outpace broader market indices like the S&P 500, as well as utilities and rates. Beyond dividends, many energy companies are actively returning capital to shareholders through significant share buyback programs. Companies like Chevron, ConocoPhillips, and EOG Resources have announced substantial buyback targets for 2025. These repurchases reduce the number of outstanding shares, boosting earnings per share and potentially supporting higher stock prices over time. Combining solid dividend yields with buybacks, the total return potential for some segments, like energy infrastructure, is estimated to exceed 12% in 2025. Energy stocks can also serve as an effective hedge against inflation. Energy is a fundamental input cost across the economy, so rising energy prices often correlate with broader inflationary pressures. Companies that produce or transport energy can often pass these higher prices along, potentially boosting their revenues and profits. During inflationary periods, unlike companies in many other sectors, While the long-term transition to renewables is underway, the reality is, as we discussed earlier, global demand for oil and gas is expected to remain robust, even grow for at least the next decade. This provides a solid foundation for the profitability of well-managed energy companies. Furthermore, there's potential for valuation upside. Some argue that parts of the energy sector, particularly infrastructure, may see valuation multiples expand as investors recognize their resilience, income potential, and the increasing role they play in supporting both traditional energy flows and the integration of new energy sources. The emergence of AI-driven electricity demand could also enhance investor sentiment towards companies enabling this growth. However, investing in energy is not without risks. The most prominent is commodity price volatility. Oil and natural gas prices can swing dramatically based on supply, demand, geopolitical events, and even weather patterns. While infrastructure companies are somewhat insulated due to fee-based models, their correlation with crude prices, though reduced, has not disappeared entirely. Regulatory and policy changes also pose a risk. Environmental regulations, shifts in drilling permits, carbon taxes, or accelerated mandates for renewable energy can all impact the operating environment and long-term prospects for fossil fuel companies. The long-term energy transition itself presents a risk. While demand is currently strong, the eventual shift away from fossil fuels could lead to declining demand and potentially stranded assets for companies that fail to adapt or diversify effectively. Finally, there's execution risk. Large energy projects are complex and capital-intensive. Delays, cost overruns, or operational issues can significantly impact a company's financial performance and returns. Balancing these potential rewards, strong income, buybacks, inflation protection, valuation upside, against the inherent risks, volatility, policy changes, transition risk, execution risk, is key to making informed investment decisions in the energy sector. Now for the part many of you have been waiting for, spotlighting some top U.S. energy stocks to consider for their dividend and growth potential in 2025. Our selection focuses on companies with strong financial health, attractive dividend profiles, yield and growth, proven operational capabilities, and strategic positioning for the future. Remember, this is for informational purposes. Always conduct your own due diligence before investing. First up, a true titan of the industry, ExxonMobil, ticker symbol XOM. As one of the world's largest integrated oil and gas companies, ExxonMobil operates across the entire energy value chain, from exploration and production upstream to refining and marketing downstream and chemicals. Its sheer scale, diversification, and technological expertise provide significant competitive advantages. From a dividend perspective, ExxonMobil is a stalwart. It's a dividend aristocrat, having increased its annual dividend for over 40 consecutive years. As of late 2024, its dividend yield hovers around 3.5%, offering a solid income stream for investors. Beyond dividends, ExxonMobil is also focused on growth. The company is strategically investing in high-return projects, particularly in the Permian Basin and Guyana, which are expected to drive significant production growth in the coming years. Its investments in carbon capture and storage technologies also position it to potentially benefit from the energy transition while leveraging its existing expertise.